Hey everybody, Brian Shannon here from alphatrends.net. It's Friday, the 12th of February, 2016, and we had another losing week for equities. The S&P lost a little less than 1%. NASDAQ almost break even. Russell 2000, I won't read these numbers to you, but oil, despite a 4% rally today, was still down 6% for the week, and 3% rally in biotechs today, still down 2% for the week. So, we're still in bear market. Don't listen to people who say otherwise. The fact is, we're in a bull market, and some of the strongest rallies tend to occur when we are in a bearish environment, such as now. So let's just minimize that and take a look at the action. If you recall last week, what we were looking at was we were stuck, basically, not stuck, but we were resting right here at this level of support. And what I was hoping we would see last Friday was a little bit of a rally and then an opportunity to get short as it broke down. Well, of course, the market doesn't care what I want or think should happen. Instead, it gapped lower on Monday, and that kind of set the tone for the rest of the week here. The volume-weighted average price for the week, we did finally finish above today, so let's just draw that back in here. Here's the volume-weighted average price for the week, and of course, Thursday we had that big gap down, and the market came down to the prior level where we've seen support near 181. We actually undercut on an intraday pre-market basis. We undercut this January low. Let's just back that up for a day onto the daily time frame for a moment. We'll come right back to that. But on the daily time frame, this has been an important area that has held support for the last, basically last year or so. And we came down and tested it once again. And as the phrase goes, the more the times that support or resistance is tested, the more likely it is to fail. So we're getting another bounce right now. But again, we're below a declining 10, 20, 30, 40 week moving average. This might have been the low of this bearish environment. I highly doubt it, though. We are still below a declining 10, 20, 50-day moving average, and we still have a 5-day moving average, which is declining. So we can't trust this type of action. Use these rallies for trades if that's what your mentality is. It is for me, certainly, or to lighten up on positions that you're uncertain of, because what we tend to see happen is we see lower highs, we see less frequency between the tests of that support, and then eventually we see a breakdown, which leads to lower lows and a continuation of the primary trend, which is currently lower. When we have consolidations, they tend to resolve themselves in the direction of the primary trend, and there is no doubt that the primary trend is lower here. This is not the first bear market that we've seen, that I've seen. It's basically the third big one. In fact, even back in 1990, there was a big decline in the NASDAQ that people tend to forget about. So arguably the fourth one. But the fact is, we are in a bearish environment right now, and we're getting a bounce. Now, how far that bounce goes is anyone's guess. All we can do is look to see potential levels of support or resistance. So if you follow Alpha Trends on Twitter or on StockTwits, you'll know that I sent this chart out on Wednesday, I guess, and I was saying basically that if you took the volume weighted average price from the January low, that volume weighted average price came in right here. That's that purple line. I also drew in a retracement of this high right here in February to the pullback low, and it drew the Fibonacci levels on there. So this is a 38.2% retracement right here. This is a 50% retracement. So we came into basically the volume weighted average price since the January low, the 50% retracement of this decline as it rallied up, and it was also, of course, this prior band of support which had the ability to and did in fact act as resistance. So let's just clear this all off for a moment and focus back on this S&P 500. This is a 30-minute chart, meaning each candle represents 30 minutes of trading. So this prior band of support acted as resistance. This is where that volume weighted average price was drawn in, and here is the Fibonacci that was drawn in at that time, prior of course to the, or I'm sorry, prior of course to the new low that we saw on Wednesday. So a 50% retracement brought it right to here, which was just below the volume weighted average price from the January low, and it was also the location of the declining 5-day moving average. It's this blue moving average. The direction of the 5-day moving average is what we base the intermediate term odds to continue on. So in other words, when we have a declining 5-day moving average, the odds favor continuation to the downside. And as I always say, we do not trust rallies while the 5-day moving average is declining. It doesn't mean you can't make money on these rallies, but you have to accept them for what they are. Now where we are, however, is that we see this market is starting to show a little bit of signs that the buyers are getting more interested down here. This is the volume weighted average price of the last 5 days. You can see that that comes together with the 5-day moving average. So next week, what we would be looking for is ideally a pullback down towards here. And maybe we run up to this prior support once again and find resistance, then come back down. That would even strengthen it further because the 5-day moving average would be advancing, as would that volume weighted average price. So perhaps we see this. And I'm just laying out what I think are the best case scenarios to trade based on. What we need to do is be flexible each day, and we can't just look at the market once a week and figure out what we think it might end up doing. In fact, today I had posted this on Twitter right before the open of the market, that a lot of times what we see when we have a strong decline in the market, 3 to 7 days, we see a gap higher. If it gets above that 5-day moving average, what we tend to see is that it rallies a little bit, pulls back, and this is meant to be the volume weighted average price. That's the red line. So we see it gaps up, pulls back, and once it gets back above that volume weighted average price, that's where the buyers regain control. It often sees a little bit of a pullback here midday and then goes on to close near the high of the day. Well, here's what happened today. This is, we'll look at a 2-minute chart of the last 2 days, and we'll clear all that out. So today we had the gap higher. Now let's add today's volume weighted average price in there. And here's the volume weighted average price. As I mentioned to subscribers of Alpha Trends, this is where it was on for the buyers. The buyers took control there for the session, and with a stop below the low of the day, we were expecting the market to close right near the highs, and in fact they closed exactly at the highs. And I warn people, it's not meant to be a blueprint for what will happen, but it's a high likelihood. We had the midday pullback and it got halted right at the volume weighted average price, showing how strong the urgency, or how much urgency there was for shorts to cover and for new money to come into this market. It wouldn't even break below that volume weighted average price. So, you have to take it day by day. And the fact remains, we are in a bearish environment here. Call it a bear market, call it whatever you want. I've been calling it a bear market, as you guys know, since right here on this day. And my mind is unwavering that we're in a bear market. It doesn't mean we're not going to experience some nice rallies. We get sharp rallies in a downtrending environment. Maybe this one goes all the way up to 192, 193, and you have all kinds of people on TV celebrating, saying that was the low. But again, the more times support is tested, the more likely it is to fail. So going into next week, ideally we would see some pullback here that then gives us the opportunity to look at the potential for more longs, and the key band of resistance that we need to get back above to have a little bit more confidence in this market on the for swing trades would be for it to get back above and hold above this level. So maybe it pulls back, rallies up, does something like this, spends some time in here, and then it would either have the ability to continue higher or more than likely break back down. That's just the environment we're in. I'm not cheering for the short side. I was, yelled at for years for people saying that's it, the market's over. And I said, well, we still are in a bullish market, so give the benefit of the doubt to the buyers. Now we're in a bearish environment. Give the benefit of the doubt to the sellers. The NASDAQ lost ground as well this week, although again, not very much, only 10 basis points on the bearish side there. But But still, that doesn't change the fact that we're down close to 6% this month and 12% year to date. So nothing to get excited about. The weekly chart here still clearly broken. You can argue all day long that it's oversold and it needs to do this or it needs to do that, but we've got a major potential obstacle. I don't know if I said that properly, but a potential major obstacle just above that is this prior band of support in here and that round number near 100. It doesn't mean the market will be thwarted at that level and turn back lower, but it's a potential level of resistance, and we want to be aware of the fact that because the longer term trend is lower, this is a highly likely area to become resistance once again. Markets don't turn on a dime. Look how long it took for these markets to top out. It took them a year of of sideways choppy action. Now for this market to turn right back around to the upside, it's kind of naive to think it's going to do that. So here's our first potential band of resistance for next week, and then up in this area. So the ideal scenario would be, maybe we get a gap up or even a gap down on Monday would be better. Come down, hold the 5-day moving average, and then rally up in here, do some work at this level, and then punch up towards that 100 level, and we'll see what happens from there. I'm not here to predict where the market's going to be at the end of the year. That's completely irrelevant to making money on a daily, weekly, and monthly basis. Our job is to manage risk and recognize the environment that we're in. We're in a bearish environment, and that doesn't change overnight. So the Russell 2000 has been really the most beat up. We had the potential that this was from a failed move lower comes a fast move higher. It doesn't mean that's what it is, but we look at that and say, it broke down below this level that had offered some support for a little bit, and it's deeply oversold. I mean, think about the people who sold short under that level. What the heck were you waiting for to sell short? Or the people who put stops under there. People put stops under there because maybe they bought it on this day and this day, and they thump their chest on Twitter or wherever they brag about, and they say, I'm going to put my stop below here. Well, why not put your stop underneath the most recent relevant higher low, rather than thinking that you're picking the bottom in a downtrend? Anyways, the point is that we suck the uneducated short sellers in right here. We have the weak longs to give up, and then we have bargain hunters come in, and then shorts start to cover, and it's that cycle that can bring this market perhaps up towards the 100 level, or at least up into, let's say, 98.5, 99 is the biggest potential band of support. Let me clear that all off because it's obviously a mess. We can look at what's the volume weighted average price from the recent peak? Well, 97.50. So perhaps we, do something like this. And this has been resistance earlier this week. And perhaps we do something like this and then are able to push beyond that. Then we can think about the next potential level of upside. But support broken tends to act as resistance. And that's because you think about the psychology of the holders over here who were buying and saying, I've got it, I've got the bottom. Then they get the crap kicked out of them, and it gets the psychology becomes, give me my money back. I just want my money back. If I can get back to even, then perhaps I'm going to get out and put a painting on the wall rather than invest in this silly stock market. Here we have the potential for an inverted head and shoulders pattern. Fine, it's on an intraday basis. It doesn't mean a whole lot, so let's just clear that off and be aware that the market is still very fragile. On the longer term, we're still in a horrific downtrend. You can talk about measured moves and how moving from 129 down to 107 was 22 points, and dropping 22 points down to 98, the measured move objective has been met. So perhaps we get a little bit bigger rally, and perhaps we even get all the way up to 104, but that is not enough to say we're out of this bear market. So again, just know your time frame more than anything, and be aware of where the potential for resistance would become, and then say, okay, that's potential resistance. It doesn't mean short there. It means look for evidence that the sellers are gaining control, and as they gain control, then you short as it starts to pull back once again. Semiconductors came up to what's been an important level this year of 46 and a half. And if we go back, we can see that, here we are kind of in this area, this 46 and a half. Then we have, excuse me, the same potential that we had just seen in the Russell 2000 from a failed breakdown could potentially come a fast move higher. Up to where? Where's the potential for resistance? The potential for resistance is, in my mind, pretty clear here that this is the bigger potential band of resistance near about 47.5 to 48. So, that's a point and a point to point and a half away. Is the risk worth the reward to you? That's something you have to decide for yourself. Let's erase all that and take a look at the volume weighted average price for the week. We were able to close above that off these lows and then off these highs. We can see that, off the highs, the volume weighted average price is up here near about $47.60 a share, which is the prior band of support and adds credence to that level as a potential area where we do in fact find resistance. For next week, I think if we're going to see further bounce, we want to see probably about $46 hold. So in other words, if it pulled back towards that, then we do a little bit of sideways action. That's actually preferred because we would see that 5-day moving average flattening out and give the opportunity for that market to continue higher. The biotechs, you can see I've been talking about these and talking about the fact that prior support tends to act as resistance. And here we see it, again, that the 5-day moving average was declining and it broke above that, but it takes more than, you can't trust an intermediate term rally with a declining 5-day moving average. And that's still where we are here. So the ideal scenario for biotechs, one, we found support down near that 240 level. That's good on one hand. But the fact is we're still in a horrific downtrend. And even if you just take, a trend line that looks like this, let's say it rallies up to that trend line, that's also this prior band of support. So yes, you can say they're down too much, but down too much doesn't mean anything as long as there's more sellers coming. And if anything, the oil market has shown that, or some of these other markets that have been in horrible downtrends. Let's back it up to a weekly time frame. Down a whole bunch, due for a bounce. Absolutely. That's what common sense tells you. But common sense also told you that 3 weeks ago, 4 weeks ago, 3 weeks ago, and 2 weeks ago. Wait for the actual evidence that the buyers are gaining control. And right now, you look at this daily time frame. Look at it reasonably, not emotionally. Reasonably, it says we still have lower highs and lower lows. There is nothing here that says this market is in an uptrend on the daily time frame. There's nothing here on the 30-minute time frame that suggests we're in an uptrend. We have 1 day of bounce. That's it so far. One day makes not a trend. So what we want to look for is maybe a scenario that it bounces by pulling back and we find some support at this area in here, and then we start to work and come up towards this level. It's a lot of hard work to get through all these levels. Markets don't turn on a dime. The path of least resistance is still lower, and we've got all these prior levels of support. Support broken tends to act as resistance because there's people who bought in here thinking it was the low, and they're saying, just give me my money back. I want to get out. So it takes time. If they don't scare you out on the way down, they will wear you out as it turns sideways. They suck new people in long, and then we see, resumptions of downtrends. That's the way bear markets work. To try to predict the bottom is foolish. I promise it will be well after the biotechs or any of these markets make their absolute low that I will call a bottom. I did not call a top up in here, nor did I attempt to. Over here, I was saying, looks like we're entering a bear market. That's the way you want to look at the market. Shares of Apple are still in a bearish environment. It's still a piece of garbage stock. And I'm not picking on Apple. I'm picking on the psychology of people who want to believe in a company so much because they use it. As I mentioned this week on Twitter, I was talking about Twitter and the fact that I've been calling this a piece of garbage for quite a while. I, made that little comic about, hi, I'm at Jack, and I'm a new CEO. I'll make you rich. That was at 28 bucks a share. It got cut in half since then. But the point is, it's in a downtrend. It's guilty till proven innocent. This is where the new CEO came in. You can point to all kinds of news things in the past, but the fact remains, even with a 10% rally today, 11% rally today, it's still in a horrific downtrend. You can argue all you want that, well, now it's out, the news is out, and it can go forward from here. But any uptrend, any rally in Twitter will not be easy to sustain because we have this downtrend and we have supply overhead that we'll have to work through. So Twitter, perhaps it pulls back down towards here and begins the bottoming process. And maybe that was the ultimate low. But I will guarantee you that people were calling this the ultimate low. Then they said this was it. They said this was it. They said that was a successful test. Then they called that the low. Now they're calling this the low. Nobody knows. Use common sense. What is the path of least resistance? So in Apple, what's the path of least resistance? Is it easier for this stock to turn higher or lower? What about since the most recent relative event, the catalyst, the most recent earnings report, when the stock gapped lower, the average price the stock has traded at since then is right here at about 95 bucks a share. Since that earnings report, we've traded in a wide range where it's gone from 93 basically to 97 and a half. We're almost to the midpoint of that range, but what a waste of time. There are so many other stocks out there. Why waste your time with Apple? That's the point. I'm not picking on any stock. I'm trying to help people understand that when a stock is going down, it can have the best product on the planet and it can be the most profitable per employee, and any other metric, it can be undervalued. They can pay a huge dividend. Their CEO can say anything. They can buy back shares. But the fact is, there are net sellers of these stocks. Why would you want to be a net buyer of these stocks when the biggest money on the planet that creates these trends is selling? It just simply does not make sense. So let's talk about bonds. Bonds have had a huge rally since our Federal Reserve Chair raised rates. So incidentally, of course, the yields are plummeting. And this week we saw, maybe the near-term end to this rally with this big red candle here. But, the fact is, the path of least resistance for bonds is higher. There are more buyers than there are sellers. People can talk about all they want about the Fed policy and that, but the market is smarter than the Fed. They say don't fight the Fed, don't fight the trend. Not even the Fed is bigger than the trend. Let's talk about the thing that people keep bugging me about. And let me tell you why I'm not going to talk about it after this. For years, I would look at gold and say, gold's in a downtrend. Gold gaps every day. I don't trade gold. I don't have any interest in gold. So I'm not going to talk about gold. I stopped talking about gold over here. I said, I just have no interest. I don't like gold. I won't like gold. I don't care if it goes to $2,000 an ounce. I don't care if it goes to 2,500. That's not going to make me like it. I don't like it. I don't like to trade it. I look at it for subscribers when they ask me to, but otherwise I'm not going to talk about it. I can't believe in it. I don't trade in it. Why would you want my opinion about something I don't care about? It doesn't make sense to me. So don't get angry if I don't talk about gold, because it's like the Apple, fanboys, or the Apple worms. These gold bugs are just, they tend to be quite annoying. They've been defending gold all the way down, and maybe it goes to who knows whatever. The point is, please don't ask me to talk about it. It's a good way to get yourself blocked. Otherwise, have a good weekend, long weekend, and I'll see you back here next week. Thanks.